Hello, everyone. Good morning. Hello, good morning. Hello, everyone. Good morning. Let me welcome us to another exciting morning market review here on Rally Academy Rally Trade. My name is Emmanuel Odogu. I'm reaching you from the beautiful city of Sabah. I think the weather is quite calm this morning, and of course, just lovely. So we'll be doing what we always do, just as our tradition is, go through the market, try to take you through what the market has been doing and also what the market will do, right? So forecast what the market will do. Let's do a little sound check here. So let me check the chat room. Okay, wonderful. For you to have responded here, it means you all can hear me. Thank you very much. I really appreciate the response this morning. It means traders are really ready to hit the market really hard this morning. All right, guys. I think we have just a few number in the room. So perhaps maybe in the next 1, 2 minutes we'll start properly, right? Let's wait for more persons. Perhaps uh, traffic is holding them on the road. So in the next 1, 2 minutes we'll get started. Thank you very much, guys. All right, everyone, we're starting right now. I think we have good numbers right now. So, good morning once again. This is Rally Trade Morning Markets Review. We do this every morning by 8 a.m. to 9 a.m. One solid hour of market analysis where we try to give you tips and tricks on how to navigate the market profitably. What we do is we give you previews of what the market has done so that you can be able to always have a net profit, okay? So for you to call yourself a profitable trader, we mean you are actually having a net profit, right? So most new traders think they will not actually, or the market will not actually hit their stop loss. No, most new traders, right? But then, for you to be a profitable trader, it means at the end of the day, your profits are far more than your losses, right? So that's what we call net profit, right? So that is why one thing you need to do is to diversify your portfolio, right? So you can diversify your portfolio in such a way that you are not going all in. You're not going all in with the money you have, right? I mean, you're not even placing or using all your loss size on a particular instrument, right? So you diversify. So that means, let me put it this way: the money you would have used to place one trade, you can use that same money to place three different trades. Or let me put it this way: your stop losses for one trade can be your stop loss across three different trades. So, for example, let's say your stop loss for a particular trade is 20,000 naira, right? So that 20,000 naira can actually place three trade, right? So I mean, you can actually give it three positions. So you can diversify in such a way that, let's say that minus 20K for stop loss of one trade, because you have used a very big loss size on only one trade because you're not diversifying, you can actually um, do trade number one, stop loss of perhaps, let's say, minus 7.5. Trade number two, stop loss of, let's say, minus 7.5. Trade number three, stop loss of 5K. So that means you have used, you have been able to use that same stop loss of 20K, right, to place three different trades. So guys, welcome to this session. So that one was just a rant. Okay. So we are getting started right now. So just as our custom is, what we do is we always like to start from fundamental analysis. Fundamental analysis. So once again, those for just joining us, this is Emmanuel Udogu. I'm reaching you from the beautiful city of Asaba. Asaba is very fine this morning. The weather is cool. Of course, everything is going on fine. So I'll just share my screen right now with you. Okay. So and the screen I'll share is my Forex Factory. Okay. So let me do that right now. Wait. So guys, I've been able to share my screen with you. Okay, just type FF, just type hello everyone. I've been able to share my screen with you. Just type FF uh in the chat room, indicating you can see, my screen. Okay, thank you very much. Thank you very much, guys. I appreciate the response there. All right, so this is Forex Factory. Now, this is one of the websites we normally use for fundamentals. So one of the websites, not the only website, one of the websites. So you can use investing.com, you can use myfacebook.com, tradingeconomics.com, FS Street, several websites, right? But then let's go ahead. So what I normally do is you just type on your browser. For those of us joining us, you just type on your browser. For those of us joining us for the first time, uh, you just type on your browser www.forestfactory.com. It opens this website. Then you may want to click on calendar, right? So we're trying to look at fundamentals. So fundamentals are actually the news events across the globe that affect the financial market. So you don't want to sleep on this because the fundamentals are the major catalysts. And that's a nice word. that it is a major catalyst that actually move the market, right? So the market is moving from point A to point B is being driven by fundamentals. Then, of course, with technical analysis, you can accurately time with a break of structure, market structure, demand and supply, support and resistance. You can use those things to time your entry. But take note, fundamentals very important. So this is Sunday, Monday. All of this has passed. So those of us joining us, you may be wondering what are they called, what are these colors, right? So we'll focus on the red one, trying to be fast here. The red ones are the high impact news. High impact. Another word for impact is volatility. So if you're hearing it for the first time, volatility simply means the rate of change of price with time, right? So price moving very fast. Okay, moving from point A to a point B very fast. Okay, so that will mean it's very, very volatile. Okay, so during this high impact news, the red ones, we normally see high volatility, right? Infused into the marketplace. And of course, you know, traders will wine and dine volatility. So that means without volatility, trader don't have money in his pockets, right? With volatility, we have money, okay? Okay, so you understand that very well. So for today, being Friday, as you can see, blessed day of the Lord, in the year 2024, June precisely 28th. As you can see, we are looking for red news, high impact news, I mean. So this is medium impact, as a brown one, right? So for today, without wasting much time, the high impact news is by 1:30 p.m. Nigeria time. As you can see, 1:30 p.m. Nigeria time. Okay. So, and then we have a high impact news on Canadian dollar, and of course, the United States dollar, as you can see, right? So for the Canadian dollar by 1:30 p.m., we're having a news there, right? And that news is on GDP. So GDP is simply gross domestic product month on month. So that means this particular one is measured monthly, right? So GDP is simply a measure of the total value of goods and services produced within the border of the Canadian economy. So simply put, they are trying to know how the Canadian economy is doing, and they normally measure GDP yearly, quarterly, but this one now is monthly, right? Okay, so the value we are expecting, so what will determine whether we are to buy or to sell is this value here. So this is actually blank, right? So it's blank because it's not yet 1:30. So by 1:30, few hours from now, you're going to see values here. So simply put, so that we don't waste or so that we don't stay longer here. So simply put, if the value here is actually greater than the forecast, you see it green, right? So it means it is good, right? It means Canadian economy is actually expanding. More people are getting jobs, right? The economy is booming. So that simply means it will attract more FDI, foreign direct investment. I mean, there will be direct demand for the Canadian currency. And that demand is what increases the value. So simply put, if these values here comes out, for example, if by 1:30 and you see 0.4, 0.4 is obviously bigger than 0.3, right? So that means it is good. It will come out green. So what do? You buy the Canadian currency, right? All right, so you understand that very well. So what of it is red? That means it's bad for the Canadian currency. So you said, I want to believe you know how to buy a currency in a currency pair. I want to believe you know how to sell a currency in a currency pair. Uh-huh. All right, you already know that. My spirit is telling me that. So the second news we have here is the core PCE, personal consumption expenditure. Wow. That's the meaning of PCE, personal consumption expenditure, right? And this one is measured month on month, right? So this personal consumption expenditure is actually one of the ways the Federal Reserve normally measures inflation, right? So normally look at the inflation that is creeping into the economy. So so the Federal Reserve, by Federal Reserve, I mean that is their own federal government and their own central bank in the US, right? So it is used to measure inflation. And of course, you know, inflation is important to know the value of currency valuation, right? So that is why the central bank, they have that core mandate to monitor these values, right? So actually, PCE is it measures the change in the price of goods and services as purchased by the consumer, right? So PCE measures the change in the price of goods and services as purchased by the consumer. Somebody's thinking, this definition is not the same definition for CPI. Of course, it's the same thing with CPI. So CPI also measures the changes in the price of goods and services purchased by the consumer. But the only difference is that PCE is actually for individuals, right? So it doesn't target companies and, of course, large corporations. Is just for individuals, okay? Just for individuals. So we are trying to know how the inflation that is creeping into the economy is affecting consumer spending, right? And consumer spending is one of the major drivers of the economy, if you understand that. So simply put, is this particular news is actually a measure of inflation, right? So forget about the long story or the grammar. It's a measure of inflation. So in the US they are trying to know measure inflation, right? From the individual perspective, not companies here, not factories now, but for individuals' perspective, right? So simply put, since CPI is usually released before the PCE, CPI seems to take most of the glory. By glory here, you understand what I mean? I mean volatility. CPI seems to take most of the glory, right? From the.
I forgot to tell you yesterday, as I see you now, I remember. Was it yesterday or 2 days ago? This guy called, Rookie chats me up. Rookie, okay.
Let me mute this guy that is talking here. I've been able to mute it. So let me just go straight. The difference between this particular news and the CPI, and the reason why I'm hammering on CPI because all of us here, we actually made a lot of money from CPI. So we're actually looking forward to another CPI. So this is actually a brother to CPI, right? So the difference is just PC is released 10 days, usually 10, 11, 12, 10, 11, or 12 days after CPI. That's when PC is released. And of course, PCE is also a good indicator to measure inflation. So actually, the price will move, okay? Don't get me wrong, the price will move. So one of the ways we trade PCE is to use this method that has been working very well. It works like fire. I can tell you that. A lot of persons are giving testimony. So you can do a buy stop above the market price. That will just be 10 minutes before the news, and do a sell stop below the market price. That will just be another 10 minutes before the news. And wait for the reaction by 1:30. So you may want to do that by 1:20. So guys, I think we have spent enough time already on this. Time is really running fast. So let's jump into technical analysis right now, guys. I hope we are good. Okay, I hope all of you can hear me. So let me jump into technical. So before leaving this fundamental, now it is we can say that for today you make money from PC, right? So it is safe to say for today you make money, right? So have that confidence. It all starts from the mind. So for today you make money, but then you just want to use a moderate lot size that is commensurate with your account size. If your account is small, what is that money doing in the bank? You can start withdrawing from your account right now, or doing a transfer to fund the top of the Iranian president. I've been able to meet that guy. Okay, sorry about that, please. So you can do a top up on your account so that you can so that your account will be robust enough to make this trade. Okay, so guys, let me share my screen right now so that I can show you what is happening on my chart. So are we good? I hope we are good. So I've been able to share my screen, guys. So this is my MT4. Okay. So we can use MT4 or MT5, actually, anyone. Okay. So you can see my chart. So just type chart, please, so that we can move on real quick. So type charts, that's another kind of sound check there. Type charts so that we can move on real quick. So the type of technical analysis we do is called market structure analysis. So guys, you can see my chart. You've typed chart. I want to believe you've typed. Okay, thank you very much. So the type of technical analysis we do is market structure analysis, right? So we try to look at what the market structure is telling us. So what is market structure? It's simply whatever you're seeing on the charts, right? It's the market structure, right? So usually characterized by the highs and the lows. I mean, the highs and the lows are actually the major parts of the chart when you're talking about market structure, right? So where are the highs and the lows? As you can see from my chart, I've been able to mark the highs and of course the lows. By marking the highs and the lows, you can tell vividly where the market is, where the market is actually going. And then we'll call that the language of financial markets. The market trying to communicate to you, to communicate to traders, hey, look here, we are down, or we have stopped going down, and now we have reversed, and now we have started going up. So from what we did last time I was here on Friday, we saw that what we said was the market was actually going to trade above this high, right? If you can remember, those of you that joined last time, you can remember that. And of course, what has happened? The market has traded above that high. Trading above the high is who is this person?
Yeah,
Who is that person that is always distracting us? It is well, oh. All right. So the last time we said the market was going to actually trade above this. Now, please, this is USD index, right? On the H4 time frame, right? Well, why USD index? USD index because we want to look at what is primarily happening to the dollar, because most of our trade every day, every now and then has to do with the dollar, right? You're either trading you go USD, GP, USD, AD, USD, gold, NZD, USD. So even US 100, D30, or they're all affected by what happened to the dollar. So that's why we try to look at the dollar and we can tell what is happening to the dollar. So last time we said if the market trade above this high on the H4 time frame, that high seems to be the target liquidity, and of course we have achieved that target liquidity. As you can see, we achieved that here, and of course another retracement to downside. So that was when we draw all of these lines. So as you can see from here, we're able to break through, right? So this particular line was actually the projection we did the last time that it was trading. We're going to trade above it, and of course we've been able to achieve that. So if you check to confirm most of this statement, if you check our YouTube channel, I hope you all know that we are recording this live on YouTube. We're on Zoom, but we are recording it live on YouTube. So that means if you miss anything, you can still go back to YouTube and rewatch it, okay? So if you check the YouTube channel, Rally Trade on YouTube, you will notice that we said last time this is a relatively equal high. We call that rare. So write it down, ROEH. Relatively equal highs, and relatively equal highs is actually a draw on liquidity. That means the market will be attracted to smash it. And of course, guess what, sir? The market was attracted to that area because the market moves in the direction of liquidity, right? So the market was attracted to smash that area. And of course, we've tapped that liquidity. Glory to the market for tapping the, the liquidity. Then, of course, we had this retracement. Of course, there will always be retracement, which offers lower prices. We call that a discount, right? So, and after that, it was buyers was attracted more. Were attracted more. So from there, we took out this high to form a new high. So actually, officially, you can call your friends and family and tell them, hey, USD index is now on an upward trend, right? On the H4 time frame. So what do we do with that information? We can use that information to trade GBP USD. So quick one, let's start with, or should we do Euro USD? Or GBP USD? Or let's do Euro, let's start with Euro USD, right? Okay, so we did this also again the last time, right? So because of, take note please, because of GP USD index is actually now trading upward to the upside, right? Now, see, one thing you need to have, right, to do well in this industry is for you to come up with which direction is the market going. Once you can tell that, sir, come on, you are good. Market structure helps you to tell the direction instead of just gambling and guessing the direction up and down, right? Now, so we said the USD index is now on an upward trend. We are not trying to trade what we think. We are trading what we see on the chart, right? So you trade more of what you see on the chart. So that is what market structure is about, right? So looking at GP, Euro USD here, So you can see we're already breaking structures to the downside. What do I mean by breaking structure? The market actually trading below the previous lows, right? We call that a break of structure, right? To the downside, right? And the market also respecting the previous high, respect. So that's what we call protected liquidity. If you like respected liquidity, you'll not be wrong. You'll not be wrong. All right, then. So the market respected this one because the next time it was going up, guess what? It could not trade above this high, but then it stopped here and then target this low and took out the low. So that means this low. So the market actually formed this low, but the market has not traded below this low. Okay, look at where we are right now. So the market made some attempts, right, to trade below this low, but it came very close. So if you watch carefully, the market did not trade below this low, right? Now, this type of analysis can also help you to stay on a trade for a very long time. Because remember, you don't only do retail day trading, right? You can keep a trade for a very long time, as long as 1 week, 2 weeks, 3 weeks, right? So with this type of analysis, you can keep a trade for a long time because you can always be reminding yourself this high or this low has not been taken out. That means we are still going down. So with that information, it's called mechanical trading. With that, when A move B to move C, right? So it simply means without this high being taken out, we are still going down. So let me actually increase it or draw it to the future, right? So without this high taken out, we are still going down. Why? Because in recent time on the H4 time frame, we took out this low. Remember this analysis on the H4 time frame. Now, what is the advantage of this type of analysis, right? On the lower time frame, because retail trader trade more with 15 minutes time frame, and of course 30 minutes time frame, right? So the advantage of doing this on this higher time frame is because so that if you go down the time frame, you will know whether you are trading the impulsive leg. So this leg is called an impulsive leg, or you know whether you are trading the retracement leg, right? So what the market, so the way the market move is the market move in series of impulse and retracement. So this is an impulse, which means movement of the price in the direction of the trend. So this is a retracement, what we call market correction, movement of the price opposite the direction of the trend. So what we have here, so the reason why I have marked this area is this area becomes our next target liquidity. But if you watch carefully or if like closely, you will notice the market has already put up a low, right? So look at this low. Come on, this low is actually lower than this particular low, right? So if you watch, we have actually tapped the liquidity there. Watch carefully. This particular low is even lower than this low, as you can see. So we have actually tapped this liquidity. But guess what, sir? We did not close below it, right? We did not close below it. So chances are we may actually come back to that level, right? So we are still downward until this high is taken out, until this high is taken out. So if you now move down to a much lower time frame, that will be 15 minutes time frame. So on the 15 minutes time frame, this is where you can now pick your trade, having in mind, take note, you can pick your trade having in mind that the H4 time frame is still going down. So that means you cannot afford to place a very long trade here. Even if you're buying, you can just maybe buy for a short time, and that will be trading the retracement. So at every point in time, you need to know whether you are either trading a retracement on the higher time frame or you are trading the impulsive leg. If you're trading a retracement, it's a very short trade. If you are trading the impulsive leg, come on, the trade can go in your direction for a very long time. So on this much lower time frame, 15 minutes time frame, we have actually done a break of structure. What do I mean by break of structure? Because of the higher time frame is going down, the lower time frame was equally printing this particular structure. Which structure is this? This structure is actually a downward trend. As you can see, we traded below this low to form a new low, right? And actually traded again. But guess what? We have actually broken structure. By that, I mean we have actually traded above this high on the 15 minutes time frame. So this is the earliest sign that we are actually going into a retracement, right? And of course, you can trade the retracement. You can trade the retracement, targeting this high, the liquidity resting above this high, and of course, targeting the liquidity resting also above this high, right? So what do we do? What do you do with that? we have actually traded above this high, as you can see here. So trading above that high is what we call break of structure to the upside, right? The right term for it is a shift in the market structure. And that's what called change of character. So the market have actually shifted a little bit, indicating that we are not trading above the high. So what do we do? So you just look out for what we call an order block at the lower time frame. So this is an order block at the lower time frame. This is equally another order block at the lower time frame. So what do you do with this order block? You wait for a retracement back to this order block before you can do a buy, right? You want to buy, you wait for a retracement back to this order block. If you're saying, Emmanuel, this thing is going, it's going, should I join? You can still join. That is called high risk trading, right? But waiting for a retracement back to this order block is actually a low risk trading. Let me show you an example because you have to prove everything, right? Then all of this analysis, you have to prove it to show that this thing Emmanuel is saying, does it really work? Let me show you an example. Remember, I pointed this to be the order block, right? Guess what? This red candle, it was actually the range of this red candle. I actually draw this my box, right? Now, range is actually from the high to the low. Okay, so this was the first order block, right? We saw. Now, guess what? After the market move away from that, guess what? It retraced back to that order block. Can you see? So that means if you had missed this one, retracing back to it, this is where you would have taken your trade. In the same way, sir. In the same way, there will be another opportunity. The market always presents opportunities. So there will be another opportunity to retrace back to this order block, right? All right, so you understand that. So what you do is, if the market retraces back to this order block, then you want to buy, taking note that you are only trading a retracement, right? So if you buy here, your stop loss can be below this low, right? Or even below this low. And of course, you can target this high, right? That's what you should do. But if something is moving inside you and your body is shaking, you want to enter. This thing is going up. You have seen two blue or two bullish candle. I still want to enter. Come on, you can say enter your trade. So that will be a high risk trade, and put your stop loss here and your take profit above this level. So guys, I think we are good. Let me do GPUSD real quick. So for GPUSD, I already have a sell trade here. So I've already marked out this area also, right? As areas where I can pick my trade. And those areas are actually what we call fair value gap, right? So that means areas of interest, AOI, the area that I am interested in placing my trade. Okay, you say you are okay. I think I was really driving too fast. So let me pause a little bit and look at this comment. You say when you trade Euro USD for long, that's the question here. For long, I'm not understanding this, When you trade Euro USD for long time, what time frame will you use to take my entry? Okay, you not type the question very well. So I'm sure you mean if you intend to trade Euro USD and stay on the trade for long. I'm sure that's what you mean. What time frame is ideal? Beautiful. Now, what you do is, I don't know, your name is not showing here. So, okay, Iyare. So what you do is you first analyze on the H4 time frame. If you like, you can even do the daily time frame if you intend to stay for long, right? So you analyze on that time frame, and you can, from that time frame, you should be able to tell the direction the market is going, right? So if the market is breaking structure to the upside, the market is going up. If the market is breaking structure to the downside, the market is going down, right? So that's what we did. So we analyzed from the H4 time frame. We saw that the market is breaking structure to the downside. So let me show you this. This is I think there is this other place. Okay, beautiful. H4 time frame. So I think the last time we were here, we do this, right? If you can remember, for some of you can actually remember. We do this, right? So we said the market has been trading upward. So this is what you do. This is actually what you do if you want to stay on the market for a long time. Guess what? This is H4 time frame. And of course, each of these columns, for one column to the other column is 1 week. So this is 1 week. So what you so this is 1 week, 2 weeks, 3 weeks. So with this type of analysis, you can be able to stay on the market for a long time, as long as 2 weeks, 3 weeks. Why? Because if the market is still in your direction, how do you know it has not broken structure? It has not tapped this low. That means it's still respecting this low and taking the high, respecting this low and taking the high. That is the confidence you need to stay on the market for a long time. Okay, I think I've been able to answer that. Let's move on real quick. So the last time we were here, we do this and we said GBUSD is trading upward. And then from there, we saw that it has broken structure to the downside, and now it has now started trading downward from here. I think you can remember we do this, right? So if you remember vividly, right? So I gave you a portion in this particular place where you have to place your trade. For those of you that took it, I'm sure that Friday you actually smiled. Let me show you on the 15 minutes time frame. Let me just show you so that you start having confidence in this analysis, right? So this was actually Friday. So this was actually Friday last week, this particular place, right? So Friday last week, as you can see, Friday last week is 21st, right, of June. So this was, so if you watch carefully, this is 21st of June, right? So on that 21st of June, we saw that GBUSD was actually going down, right? So this was what happened. It traded to the downside, took out this low to form a new low. And what we did was the market was trading somewhere around here, right? And we said the market will need to retrace again, right, to offer you what we call premium price. Premium price is, I think we actually drew this line, dividing this into two, right? So once you traded above this line, then you can start taking your sell. If you watch exactly the analysis played out, right? So it actually traded into this area, right? Then from here, if you have taken your trade, you can see it. Then from here, it started trading downward again, right? Still continue this structure, as you can see. So I think you need to have confidence and faith. You need to have confidence and faith in market structure analysis, because guess what? It works, right? It works. So it will always put you in what we call net profit. And by net profit, you are making profit, sir. You're always making profit, right? So if you watch carefully, gradually on this lower time frame, we saw a market structure shift, right? Market structure shift on this lower time frame, 15 minutes time frame. So we saw where the market was able to put up relatively equal high. I'm sure you can still remember that's what we call rare. So this relatively equal high is the first sign of loss of momentum on the lower time frame, right? So it's the first sign of loss of momentum. So the next time the market retraces, lower to offer discounted price, the target was to go through that relatively equal high, right? So it smashed this high to form a new high. So we have started shifting upward. So guys, you understand that? So now let's look at, this is exactly what happened last week. Remember, we promised to give you reviews and of course previews. So that's a review of what happened last, right? So on this H4 time frame, as you can see, we are still going down, right? Now we are not actually going down. It's the market that is going down, right? I'm only going up. Oh my goodness. So the market is actually going down, right? On the H4 time frame, right? See, somebody saying, Emmanuel, why are you saying so? Because by mechanical trading, and of course I mean by market structure analysis, the last low we took on the H4 time frame was the low on the downside, right? This high was responsible for taking out that low, right? To form this low. And if you watch carefully, sir, if you watch carefully. Now, this was the last low we saw, right? Then, of course, that gave this high. If you watch carefully again, the market has retraced again to take out this low, and now we have formed a new low, right? So the only disturbing thing is that, okay, yeah, actually, we actually closed below the low. So we've actually formed a new low, sir. We've actually formed a new low. So that shifts our recent protected liquidity from this level to this new level. So this is the level your eyes should be on if you want to stay on this trade for a long time, if you want to continue selling. So what do we do? So this new low becomes our target liquidity. So this is where I'm targeting. So if you watch, I already have a sell trade. I'm targeting this low, right? So now let's drop down to a much lower time frame. That will be 15 minutes time frame. So on the 15 minutes time frame, having the knowledge that the H4 time frame is actually going down, right? So what can we do here? So the first thing you can do is the market has actually retraced to the upside, as you can see here, right? So we have seen a false market structure shift. By that, I mean, we have traded above this high, right? As you can see, we've traded above this high. So that's a sign that the market is about to shift upward. Now, that shifting upward is actually a retracement to the upside, right? So don't say it's now in an upward trend. No, it's a retracement to the upside. Let me show you something here. So all of this movement to the upside, I'm sure you can see all of this movement. So all of this movement upward here, as you can see, if I should zoom into this area, you can see clearly that all of this movement upward is actually an upward trend, as you can see, right? It's actually an upward trend on the 15 minutes time frame. But guess what? This is actually a retracement, right? So most person will just be buying and be buying and be buying and forgetting that this is they are trading a retracement. And before they know it, the market smashed downward. Of course, to take them out. So in the same way, trading here is actually trading. Buying here is actually trading the retracement. So you can do that. You can take that trade targeting the highs. Which high? This high, right? Also, you can also take that trade targeting this other high. So these are the highs you can target. Now, but what can you see before you start doing that? Okay, this was even the first shift we had. We did it above this high, which is nice. So we might just need a little retracement again to come and test this level before we can start buying. So, sir, we may actually want to buy to trade the retracement to the upside, but you might need for it to retrace to this level before you buy. But my trade is a sell, as you can see, because I know that the parent trend, the higher trend, is still on the downward trend. So, guys, I want to believe we are following. So let me take questions here. So I think somebody's laughing here. Modesta. Modesta, why are you laughing? So quickly, the next thing we will analyze, let's analyze US 100. So let me do US 100. We have a lot of traders on US 100. So let's analyze US 100. So as you can see here on US 100, the market is actually on an upward trend, right? As you can see, right? You cannot deny this one now. This is actually an upward trend. What do we mean by upward trend, sir? We have actually broken structure to the upside, right? So breaking of structure to the upside is actually a show of strength, what we call show of momentum. So the market has momentum to the upside. And this is, okay, let's do this on the H4 time frame first. So even on the H4 time frame, we are actually going up. What do I mean by we are going up? We have seen a break of structure. I mean, the market trading above this high. That's a show of strength that we are actually going up, trading up, trading up, trading up. So if we are trading up, what do? We drop down to a much lower time frame. Now we are looking for opportunities to place a buy, opportunities to buy, right? So the first thing you need to come up with is your directional bias, right? And you do that on the H4 time frame as a retail trader, right? So retail traders normally look at 15 minutes time frame to place that trade, which is good and fine. But then most often than not, the market crushes them out because they may just be trading a retracement thinking they're actually trading the actual trend. So that is why you want to look at the H4 time frame, ascertain the market direction first before you drop down to a much lower time frame. So that is what we call top-down analysis. So that means you first consider the top time frame, I mean the higher time frame. Then with that information, you come down, you drop down to a much lower time frame. Then of course you can pick your trade there. So from this 15 minutes time frame, we can see we have what we call a fair value gap here. And you can see that is why the market has been very choppy inside this area. We have another fair value gap over here, as you can see. So these two areas, right? Those of us trading US 100, so these two areas are the areas that you may want to do a buy. And of course, you set your stop loss just below this area, below the low. That's a very small, a very close stop loss there, okay? So now this is 15 minutes time frame. So that means if the market drop down, to this other mark area, I may want to start doing my buy. But I will not just buy anyhow. I will not buy carelessly, right? I will only buy if I can see the market carefully shifting to the upside. How do I mean by the market is shifting to the upside? You carefully see that the market has started breaking structures to the upside on a much lower time frame. So that's what you do, sir. So let me take question, please. Okay, you're asking for gold. That is fine. Okay, let me take question. Sir, my trend line cursor is making my trend line longer than where I want it to stop. Okay, please, how can I set it like yours to be able to draw along the market structure? Wonderful, Mr. Abubakar. Abubakar, yeah, yo. All right. So quickly, what you can do is if you pick this particular, for Abubakar right now, if you pick this particular trend line and draw, it gives you an array. So it gives you a ray. A ray is actually a line that has a beginning and doesn't have an end. So that means you will see the beginning, but you cannot see the end. To draw to infinity. So what you need to do is you quickly highlight the line for Abubakar right now. You right click on the line and you go to the trend line properties. Abubakar, are you still with me? Then what you want to do is you want to off this ray. So you click parameters, you off this ray, right? So, sir, Abubakar, sir, this ray is actually checked on your own. So off it, right? I mean, put it off, then click OK. Then, of course, when you draw, it will not go to infinity. I want to believe that's the answer for you. Then for my Ogaye, Awojobi, he says, sir, please, I would like you to explain more on supply and demand areas to identifying them. Okay, that's very simple. So supply and demand areas are just what we call highs and lows, right? To make it very simple, yeah. Supply and demand areas are simply what we call highs and lows. So let me show you. I think we're using this now, right? So, sir, Awojobi, this is your name. It's a lovely name now. So, supply and demand areas is just what I've been explaining since, right? But I'll be using a different terminology, and that's a market structure terminology, right? So for you, sir, this area is actually this area where the market pick up from. This area where the market pick up from is actually our local demand zone. Local because I am on a local, I am on a lower time frame, right? I'm on a lower time frame. So this area where the market quickly pick up from, right? Now, let me explain why that is true. Because I like judging everything from the market, right? Let me explain to you why what I said is true. Now, remember this market I actually picked up from here, right? For the first instance, this market picked up from here, traded upward. It has to come down again into that area. So this area is actually a local demand zone because that was where it picked up from. And that's what we call support area. So it came back again into that area, right? Tap the liquidity below it before going up. So if you mark this area the first time, of course, you know it will always come back and test it. So if you mark a demand zone, for example, let me mark this other one. So see this other one I'm marking here. So I'll just mark this bearish candlestick from the range of the bearish candlestick. So that's another mini demand zone, if you like, a local demand zone. So that means I'm expecting the market to come back inside here again. All right, so I think that's for Oga there. But if you keep answering all of the questions, we may not analyze more. Okay. Who else again? You say AUD USD, okay? I think we need to allow price to tap into 50% market before we look for entry. Okay, Mr. Wasiu. Okay, that's fine. I've seen one Wasiu here. So, Mr. Wasiu, This your tap into 50%. Please, are you talking which instrument are you talking about? Then for the next question, kindly analyze Euro card. Now, are you just calling all these instruments or you actually have trade on them? Okay, let me do gold. Okay, let me take you Mr. Yakubu Gold. So let's do gold very quick. Yeah. Time is fast spent. Let's do gold. So gold, 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 gold. Okay. So last time we did analysis on gold, right? Now you can see the way I'm drawing all these lines on my chart. You may also want to follow suit, right? You may also want to copy. Life is easy when you copy. Most persons don't like to copy. You start your journey of success by copying those that are already doing it, right? Copy, copy. So the reason why I'm doing this is to make it easier for you, right? So you can equally do it. Now, most of the time, once you open your chart, the chart may look confusing to you. It is normal. Like, what's happening here? I don't understand. The first thing you do, you start drawing the lines, right? Is the market trading above the highs? Is it trading below the lows? That alone gives you light, right? It throws light into the chart. Darkness, we finally see a great light. So it throws light into it. You now see it clearly. For example, let's start from this daily time frame. Let me show you something here. On this daily time frame, as you can see, yesterday, now this candlestick is yesterday's candlestick. Yesterday, we traded above day 4 yesterday high, right? And of course, the low is also above day 4 yesterday's low. That's a sign of show of strength to the upside. See what I mean? So let me draw from here to here. As you can see, it traded upward, right? So this is upward, upward, upward. Then let me draw from day 4 yesterday high to yesterday's high. From here, it actually goes upward, upward. Now, this is your first directional bias, right? If you want to consider it from the higher time frame as high as daily time frame. So that shows that today has capacity to go upward. It has capacity. Now, do I place a buy trade immediately? The answer is no. But you are well informed that we have capacity to go up. Hold on a bit. Let me just take this water, please. So arming yourself with that information, then you can drop down to maybe the H4 time frame, right? So you can drop down to maybe the H4 time frame, right? Where should I keep this thing now? Okay, let's just continue. So you can drop down to maybe the H4 time frame. So on this much lower time frame, we have actually seen that, come on, this thing actually traded higher yesterday, right? So for today, what are we going to look at for? We'll look out for the market will try to present opportunities that you may want to use to trade it higher, right? So drawing our usual drawing again. So traded down to this low. And of course, it actually gave us a retracement to the upside, right? Then it traded below this low to form a new low. That's a sign of downward trend, right? Then today we are trying to, the market is trying to trade above this high. Officially trading above this high, we have now shifted on the H4 time frame, right? But we have a strong directional bias that yesterday high traded above day 4 yesterday's high. Yesterday's low traded above day 4 yesterday's low. So that's a strong directional bias that today might actually want to go upward, right? So what we want to do is the market may just be targeting this high, right? The market may be targeting this high. Targeting this high is actually going to cause a shift in the market, a shift, right, in the market structure, right? Because actually this low is still our targeted low. Okay, so let's drop down to 15 minutes time frame. So let's look for our bias, right? Our bias here on the 15 minutes time frame, whether we are going to buy or wait. So on the much lower time frame, 15 minutes time frame, so this was that big movement we saw to the upside, right? So you may want to start drawing these areas. So this area I'm drawing right now is actually our local supply area. So since the market is trading very close to the local supply, by what local supply I mean the resistance, right? So that's the everyday word on the street, the resistance. So since the market is trading just close to the resistance, I don't want to buy, right? I don't want to buy. So the market will have to break the resistance before I may want to take my buy, right? Otherwise, we may just see another retracement. So let me use Fibonacci here, draw from the low to the high. So we may just see another retracement again, right? Retracement into maybe 38.2% or even below 50% before the market would go up high. So this market needs to retrace, right? So what I'm trying to say is that this market needs to retrace from here. So that is what I'm trying to say. It needs to retrace, right? Retrace because we are already rocking this high, right? So we need the retracement. Can you trade that retracement? Why not? You can trade that retracement. How do you trade the retracement? If you're on 15 minutes time frame, right? So before you can trade a retracement, so listen carefully, everybody. If you're on 15 minutes time frame, before you can trade a retracement, before you can be sure that this level is holding it, it's about to start going downward, you may want to drop down to a much lower time frame, right? So the reason for having all of this time frame, most people don't ask, Emmanuel, which of this time frame is the best time frame? The reason for having all of this time is so that you can get more detail about what is happening. So if I need more detail, I'm rocking 15 minutes time frame right now. If I need more detail, I'll drop down to maybe 1 minute time frame or even 5 minutes time frame. But let's do 1 minute. I'll drop down to 1 minute time frame. You must have heard the story of some traders are using 1 minute time frame, right? You can drop down to 1 minute time frame and look for a change of character. By that, I mean a market structure shift, right? So 1 minute time frame should be able to show you when the market is shifting. But guess what? If you are drop down to 1 minute time frame, so that means your stop loss and take profit has to be very, very tight, very close, right? Very, very close. So on this 1 minute time frame, so you may want to see the market trade below this low, right? So you may want to see the market trade below this low. That's before you now start selling, because now this is 1 minute time frame, right? So the change of character here, or if you like, the market structure shifts, is the market not is the market not respecting this low but violating the low, right? So if the market violates this low, it means it will trade above this low to go lower, right? Then you can enter. But if I were you, I'll wait for a little retracement. So around this area, I will now enter a sell. That's how you trade. So trading below this low, right, is what we call a shift. Now this 1 minute time frame. Trading below this low is what we call a shift because you have seen that the market is rocking a resistance. So I want to believe you understand that, right? So that is when you can now start doing your sell. Otherwise, you wait for the market to retrace very well. Then, of course, trading below 50%, they want to start doing taking your buy trade. So, guys, I think it's already 9. Let me look at the questions here. Okay, we cannot be able to do that AUD USD. So the way we normally explain or take this morning markets review is such a way that we are arming you, right? We are giving you the right arsenal, such that even though we cannot be able to cover all of the instruments, right? Now, but the few ones we explain, if you understand it very well, you can take up that explanation, or you can copy it and paste it on other instrument. You can take up that exploration and of course paste it. So for you now, I can't see your name there. You can just copy and paste this market structure into ADUSD. Okay, you are saying we can call that a bullish engulfing. Okay, is that a double pattern? Okay, somebody is appealing if the class can be extended by 30 minutes. Okay, officially we cannot do that. Okay, until we come up with a new time. Okay, you're asking if that's not a double pattern of 15 minutes time frame. So let's go back to 15 minutes time frame. So this is already 5 minutes, 5 minutes after the usual closing time. Okay. So this is actually what you call double pattern. So you're not actually wrong. So, but not to bore you with too much terms and of course start breaking your head, right? So you're actually correct. So this is actually a double pattern, right? Mm. So, but then with this double pattern now, we still need the market to trade below this low, right? To confirm that we're officially going down. Okay. So guys, thank you very much. Conclusively, USD is very strong right now. So you may want to look for, you may want to follow this analysis very well so that, I mean, you can go back again and watch, right? So that you can place a sell trade, right, on GPUSD and of course, Euro USD because US is actually on an upward trend, conclusively. So guys, thank you very much. We do this every trading day, Monday to Friday. 8 a.m. is the time. My name is Emmanuel Udogu. So 09026264507. Emmanuel. So guys, thank you very much. Bye for now. Please try and join us again on Monday for another exciting analysis. Hey.